welcome back to the Idiot Investor Guide channel with your host Guy Davidson. And today it is Sharesies episode number 5. So almost half a year of investing in Sharesies. I think I actually have probably been investing for half years in Sharesies now, but almost half a year of doing these videos on my Sharesies portfolio update, and starting to make some pretty significant gains. So it's all looking good, and the first rule about Sharesies US early preview is don't talk about Sharesies US early preview. So I've got access to that, but we're not supposed to talk about it. So what I will do is very shortly I'll make a calculator that looks at the different fees of Sharesies versus Hatch versus Stake, and which is the best one to be investing in US shares, because it should be, from my understanding, open access to US shares and Sharesies by the end of this month to everyone. So look out for that. But for now, let's jump into my Sharesies portfolio. So you can see we're almost at $8,000 now, making that paper. So that's, for me, that's very impressive. If you know me, I haven't been a huge saver. Most of my life, I've enjoyed life to the fullest, which has meant spending a lot of my hard-earned money, mostly on weekends. So now I've put a big focus on saving this year. I'm not drinking the entire year, which has saved me a truckload of money, both because I'm not going out, I'm not hungover, I'm not spending money on food, alcohol, that sort of stuff. I'm able to just sort of focus and do videos like this and start saving the money. So that's been huge. COVID helped a lot, actually, because I'm not going out, not spending money. That's where I really started to save my money properly, and it's taught me some really good habits. As you can see, up 12%. That keeps fluctuating. The percentage I've realized doesn't matter as much in these platforms because, for example, I was up 20%, in early days of when I was investing, but I had less money invested. So even though now I'm only up 12%, my gains are almost $900, which when I was up 20%, they were only, less than $100. So focus less on the percentage returns through these apps because it doesn't weight them super accurately. It just kind of goes, what's the total amount you've got invested? What's the total amount of money you've invested into this stock or this ETF, and what is the current price of it, and what's the difference in those two prices? Which isn't completely accurate because you'll be buying the shares at one price and another than another. So don't focus so much on the percentage. Focus more on the total returns. That's really what you want to be looking at, because if you focus too much on the percentage, you might get caught in the trap of, okay, I'm gonna not buy more of this share because it's higher than the last time I bought it, so it's going to reduce my percentage gains in that share or that company or that ETF. So if you're too focused on the percentage, you'll essentially stop investing because you're waiting for it to come down again so that your dollar cost average stays low and your percentage returns stay high. But in reality, if you keep chipping away and keep dollar cost averaging in, then your total returns are always going to stack up. The more money you have invested, the more return you're going to get out of it, provided you're investing in the right things. And I'm no financial advisor, so don't take that as financial advice. This is just how I look at things now, because I used to be really focused on the percentage, and I've come to realize that's not as important as having money in there, because you've got to be in it to win it, and you're not going to get 20% of $100 is nowhere near as good as 12% of $7,000. So that's a good way to be looking at it. So you can see I'm a little bit late to the party on this month's update. We're already about halfway through, but I was up almost around $1,000. It sort of slid back a little bit now, probably due to the latest update with the whole COVID situation in New Zealand. But if we go and look down, so this is one thing that's worth pointing out that I'm sure a lot of you have noticed already. Sharesies has changed the layout a bit, and this sort of comes in part and parcel with the addition of US stocks. So actually, I don't know if everyone will have the same layout as me yet, because I'm in the early access of the US stocks. But anyway, I think it's quite cool because you see everything as one now, or you can go, I only want to look at ETFs, and then you'll just see the ETFs. So same with companies and managed funds. So that's, I don't know, I quite like it. Well done, Sharesies. I think it's an improvement on the layout. I thought the layout was great anyway, but I think this is an improvement for sure. Starting with the companies, in New Zealand hasn't changed. My investment in it hasn't changed. It has gone down again and sort of plateaued a bit, down at this price of around $1.30 to $1.35. Wouldn't expect that to change much. Might even go down again more because of the restrictions that have just come back in play. But yeah, I wouldn't expect that to come back up for a good while. Um, it makes you kind of wonder whether you should have sold up at the highest point. But the idea is that you hold until it gets up to historical prices. This is a long term. This isn't a short turnaround, and that was always known. It was going to take a while to recover. So I'm not going to invest any more in New Zealand. Just going to let it sit there now because, as I said in one of my previous Sharesies videos, it's not a high growth potential. It's got good potential to 2 to 3x my money. So increase my money double or 3 times once it does get up to historical levels. If it does, I'm very confident it will. But it's going to take a while. So I've put in just over $1,000 by now, 1,300. So yeah, that's where I'm gonna leave it. I'm not gonna add any more. The layout of this is all different as well. I'm sure you notice. I haven't had a good look at this layout, but um, again, I quite like it. I think it's a little bit more detailed. Wonder what happens when you click on this. That's kind of cool. Gives you a bit more of a breakdown. Interesting. We're all learning new things as I'm going through. Probably should have looked at this before I did this video. But yeah, I don't know. I think Sharesies has done a good job of the new layout. So well done. Moving on. One up there, South. That is a new investment as of last night. A friend of mine, Keith, shout out Keith, has recently got into the investment game as well. And he asked me what I thought about South. I fucking have no idea, to be honest, but I had a look at it and it's cheap. It's like 50 cents a share, which doesn't mean it's a good buy at all. You don't buy for price. I think Warren Buffett says if you buy on price, you're an idiot. I am an idiot, so I bought on price. And I don't know, like it's something that my philosophy at the moment is if I buy a company, it needs to be a company that is in a position that it could get like significant growth, like really high growth. And anyway, like if you look at the price, the good thing about these really low price shares is that, so say it's at 50 cents at the moment or whatever, it did go up to like 70 or something, I think. Yeah, like 76 cents or something. Even though there's not a lot of money, like that is a really significant increase. That's like a 50% gain on like a 50-cent price. So even though these prices are really low, even if it goes up to that amount, the percentage increase is huge, and so then your money grows significantly. Doesn't matter that it's cheap. I think it's something that people often don't think about. They look at the price of a share and they think a higher price is a good thing. Like you don't want to buy it cheap because or they look at it's only gone from 50 cents to 70 cents, so that's not a huge amount of money gained. But with shares, contrary to what I just said before, the percentage increase matters more when you're looking at the increase of a share value, not the dollar amount of the increase of the value, the percentage. So I've just kind of gone from two angles here, and I'll explain how that all works. So when you look at a share, you want to look at the percentage increase of the share will be a better return for you. When you're looking at your own total returns in the portfolio, you want to be looking at your dollar amount return. So there are two different things you're looking at. Your own personal dollar amount return is the most important thing, in my opinion. But with a share, it's not so much the dollar amount return as the percentage return, because that'll increase your money more significantly. It doesn't matter whether it's 50 cents to 70 cents or $500 to $700. That's the same percentage increase. So if it was 50 cents to a dollar or $500 to $700, 50 cents to a dollar is going to be a way better percentage return. So you'll make more money. If you put $200 in both, you would get more return out of the 50 cents to a dollar than you would the $500 to $700. Hope that makes sense. Hit me up in the comments if it doesn't. I can explain a bit better. So South anyway, that's a fucking rant. Back to South. I think that the cannabis industry has potential for really high growth. Don't know personally about this company. I had a quick look at the financials and stuff, but I never read them anyway, so I don't really know what I'm doing. So um, maybe it's the wrong one to invest in. Probably the right way to go would be to invest in a cannabis ETF, because that would cover a bunch of different companies. And if you just think the industry generally is going to be successful, like I'm in the gamer ETF in Hatch, so I just think gaming is on a upward trajectory. I should have done it years ago when I was addicted to League of Legends, but anyway, I've got into it now because it's a high growth industry, and so probably that would have been a smart thing to do with cannabis as well. I've chucked some money on Cannabis South. I'm not going to put a lot of money on it. I've put $200 by now, another 200 if it gets down to 50 cents, and then that's probably all. I'll leave it there unless I research the company a bit better. But that's just a bit of money to chuck on it. If it does significantly increase, great, good return. If I lose it all, not too worried about it. So that's the mentality you've always got to have with shares, that if you're putting money on something, you've got to be prepared to lose that, especially if it's an individual company. Delegate's still just going to keep ticking away. At the moment, I won't put more in there, but it's they're doing well. They're doing really well. Seeker, I tried to offload those shares, but I put the limit sell too high, and they've just kept dropping since then, unfortunately. So I'm just going to hold on to them for the long run and see if it comes back up or not. I don't want to sell at a loss. I don't have to sell them, so I'm not going to, because I don't want to lock in that loss. And there's a chance that it might kick back. I think it's a good company. It's in a high growth industry. Kiwi Fruit, they want to expand from $2 billion to like $8 billion in the near future. So I'm happy to just hold on to them and see how it goes. And TrueScreen is again something I knew nothing about, but they were doing a deal at 5 cents a share. I bought in, and this is a good example of the percentage increase. 5 cents a share, and it's only up to 8 cents a share, which is nothing, but the percentage increase on that is 52%. So I've made $200 off some 8-cent share. So that's where the percentage increase is really important, because the percent of your money being returned to you is valuable. I think I've just gone probably crossed everyone's wires as I've been going through this, but it makes sense to me. Onto my ETFs now, keeping it real simple. So I've got my Smart Shares, Emerging Markets Fund, NZX50, and US Large Growth Fund. Don't think I had the NZX50 last time I did an update. So Sharesies last month came out with the NZX50. So there's the NZ Top 50 and the NZX50. The difference is, and this is why I chose the NZX50, a couple of differences. First one is that the NZX50 is weighted relative to the size of the company. So it's the same top 50 shares in New Zealand, or on the New Zealand Stock Exchange, but the NZX50 says, okay, A2 Milk is the biggest one, so we're going to give them the biggest portion of the fund. So the percentage allocated to A2 Milk in the NZX50 is really big. And then it gets smaller and smaller relative to the company size as you go down the list of 50. So the smallest company in the NZX50 will have the smallest percentage weighting in the NZX50 fund. The NZ Top 50 fund has a rule that they do no more than 6% weighting to any one company. So A2 Milk has 6%, all the other companies going down have 6% each, so Main Freight and so on and so forth. That means that the smallest company in the NZX50 has the same percentage weighting as the biggest company in the NZX50 in the NZ Top 50 fund, more or less. Like, there'll be some slight differences, but they're relatively the same. The implications of that is that in the NZX50, if there's lots of volatility at the bottom end of the NZX50, so the smaller companies, if there's a lot of up and down of share prices, that will have less of an impact on the NZX50 fund than it would on the NZ Top 50 fund, because the NZX50 fund is saying, okay, this is the smallest company, so we'll give it a smaller weighting. So if that changes, it impacts the fund less. In the NZ Top 50 fund, the smaller company is the same weighting as the biggest company. So a change in the small company will have a way bigger impact on the total fund share price than a change in the biggest company. and vice versa. So basically what I'm hedging my bets is that the bigger companies in the top 50 are more stable than the smaller companies. So I'm assuming, and this is an assumption, that it will be less volatile going through the NZX 50 because the bigger companies should be more stable, should have less volatility, and I would assume are better, more established companies that do have a good potential to keep growing. A2 Milk's been doing really well. I mean, my fund's down at the moment, so maybe I've backed the wrong horse here. But the other thing I did look at as well is that from what I researched, and I may be wrong on this, they didn't have an update on here last time I looked, but from what I researched, there was no dividend. Yeah, so there's no dividend for the NZX 50 fund and less management fees. So what that means is that if you watched one of my previous videos, David Kelly explained that you get taxed on dividends in New Zealand, but not on the capital gains of your shares. So better if you're a younger investor or you don't need to live off your dividends, then better not to get dividends in the early stages and keep reinvesting your gains into the capital gain of your share, because if you're getting the dividends, you're constantly getting taxed every time you pay dividends. Whereas if it's all just capital growth, you're not getting taxed on any of that. So you're just letting it tick away. I think there's like some short-term buy and sell caveat that you do get taxed on, but if it's a long hold of a share, from my understanding, you don't get taxed on that in New Zealand at the moment. Hit me up in the comments if I'm wrong and correct me, educate the people, but that's my understanding. Interested in your thoughts as well on whether I made the right call switching from the top 50 to the NZX 50 fund. At the moment, it's down. My top 51 was doing all right, so I don't know. maybe I got it wrong. You tell me. The US Large Growth Fund is still ticking away quite nicely, up almost 12%, so can't be mad at that. Those will just keep ticking away. So we're not going to talk about US early access stocks. However, one thing to note is that you do get charged a transaction fee when you're buying and selling US ETFs through Sharesies. It's the same in Hatch as well, so that's not unique, but my tactic will be to keep investing into ETFs through the New Zealand ones like the Smart Shares and so on through Sharesies, because there's no transaction fee on those, whereas there is on the US ones. So even though now I could go straight to the the Vanguard 500 fund or something like that, I don't see the point in that, because there will be less of a management fee, but I don't have enough money for that to be significant, and there's quite a decent transaction fee on that. So I'm going to keep investing in these New Zealand ones until I have a big enough investment that the management fee starts to sting me more than the transaction fee. Then potentially I'll move them around. That's all from me today. Sorry we went on a bit of a rant, but there was a decent amount of changes to be talking about, and I hope it was all educational. Might have been some confusing messaging in there, so hit me up if some of it's not clear, and I'm happy to explain all that for you. Watch out for my Hatch and Stake portfolio updates coming out very soon, and the update on my $10 a week investment and seeing how that's going. You won't be disappointed. I'm doing much better than a bank saving account, so not surprising to me, but you might like to see that. Anyway, until next time, catch you on the channel. Have a good one.